Now is the single greatest time to buy self-storage for a number of reasons. Number one, storage is on sale right now. Reason number two, there's going to be a massive transition of self-storage ownership in the next 5 to 10 years. And this year and next year, you're buying off of discounted numbers.
Today on the show, I have the pleasure of sitting down with Joe Downs. Now, Joe is a lifelong entrepreneur with ventures across securities, mortgage, hospitality, and real estate. And he's the co-founder of Belrose Group, and he focuses on the niche opportunities in the self-storage sector. And he's leading the firm's growth from acquisitions into development and consulting. He's known for spotting niches within niches, and Joe dives deep into lesser-known industries and eagerly shares his insights with the wider audience. I'm really pumped and excited to have him on the show today to share his incredible insight with us. But enough out of me. Let's get him out here. G'day, Joe. Welcome to the show. How you doing today, mate?
I'm doing well. Yourself? Thanks for having me.
Oh, my pleasure. And we were just talking a little bit in the green room about that you're dialing in from Philadelphia, and we were trading some war stories on some fix and flips in Point Breeze for any of the listeners out there who are familiar to the Philly area. And go Birds, as they say, right? With the massive win. You also, I didn't even ask you. You must be pretty elated with the NFL win.
Yes, of course we are. I'm 51 now. So I don't live and die as much by it, but certainly, look, my entire childhood was barren of a Super Bowl. So to have 2 in the last 7 years has been, it's been very nice. It's been a lot of fun.
That's awesome. That's awesome. Yeah.
My boys are really enjoying it. So yeah, thanks for bringing it up.
Yeah, I'm sure that Monday morning was pretty. My business partner, he's also Australian, married a girl from Philly, and he had a bit of a sore head on that Monday morning for sure.
So I actually I quit drinking about 4 years ago.
Good for you.
But if I recall the 2018 Super Bowl, I think how did you put it? A sore head? Yeah, I had a sore head that Monday morning too.
Well, cool, dude. Look. At the start of every show, we like to ask our guests: can you rewind the clock and tell me how you made your first ever dollar as a kid?
Had to be. What's funny is I didn't realize until later in life that I was an entrepreneur this whole time. So I used to break. I'll explain what it is, but I used to break lath, which if you flipped old houses, those were the thin wood strips that they put the plaster on.
Yep.
So my dad, when he redid our house, he meticulously took the lath off the walls. Why would you do that? So that your son could then break it into bags and use it for kindling for our fireplace. But then we had so much of it, I used to break it up, bag it, and go around the neighborhood and sell it for like $10 a bag. So it was all it was kindling too, by the way. And then I was probably 11 or 12 when I used to do that. And then I guess maybe that same year after that, he started shoveling driveways. But you can only do that in winter. And then in the summer, I should actually talk about this more. In the summers, I started caddying, and I made a lot of money. I paid for my high school. So speaking of Philadelphia, St. Joe's Prep, if you're for that name, it's in North Philadelphia. I paid for my high school myself because I'm one of 12, so I'm from a big family.
Whoa.
So it's private Catholic high school, and my parents just could afford it, and I wanted to go there. So I paid for it by caddying in the summer. So
wow.
I don't know. I'm not that quick on the uptake, I guess, because it took me till I was like 40 something to realize maybe I was an entrepreneur. But so that's how I made my first dollars, and kind of back. Always worked. Always been working. Always had a job, usually 2 or 3.
Dig into that 12, 1 of 12. Like I've never met anyone from 1 of 12. That's insane.
Really?
What was growing up in a 1 in 12? Yeah, well, that's old school Irish Catholic. You know what I mean? Like you hear of those like wives' tales of like, I was born at 16. You're like, what the hell was your poor mother?
To be fair, we were above average, depending on how you look at.
Yeah, right.
I guess the average is probably 6, but yeah.
What was it like growing up?
I don't know. I guess every time my dad went away, 9 months later, I had a kid. So.
But so what was the age range? And your poor mother, being a mum for, God, even if you doubled 12, that's still 24 years. And I'm sure there was some gaps in between.
So her PIN code for her ATM card at one point, for a long time actually, was 1972. And that's because that was the only year she wasn't pregnant for like 6 years. Like there's no point in there where she was pregnant. I was born in 73 and I have four older sisters. So they were all born 71 and into 68 or whatever. So yeah, there were some gaps. It was, and it's interesting how it breaks down. 8 girls, 4 boys. I'm the oldest boy. We've one set of twins.
Wow.
So yeah,
That's
it's
the gatherings. I'm sure your gatherings and Christmases and Easters, you can't all get together because it must be. You do?
well, we go every other. We're older now, right? So we go every other. We try to get together, and usually it happens. Sometimes somebody can't make it, but because half of us, I think it's half live in the Philly area.
Mm-hmm.
The other half live all around. I have a sister in LA, Kansas City, Portland, DC, Tampa, and Charleston.
Yeah, wow. That's big family. And then you got all the kids, from there when they get together.
25 grandkids. Yeah.
Wow. And is your mum still kicking?
She's not actually.
Oh,
she just
I'm sorry. I'm sorry about that. But that's a real. She would be so proud of the family that obviously she single handedly.
She was. You're gonna make me choke up now. But yeah, it was quite the fitting tribute at her funeral.
Yeah. Well, rest in peace, as they say. And thanks for taking a trip down memory lane again. I've not met too many people with more than 2 basketball teams as as a bunch of kids.
Field and offense in football.
Yeah, there we go. But mate, let's dig into your real estate background. So you mentioned earlier that you was 40. You realized that you didn't become an entrepreneur until you're 40. I'm sort of connecting the dots. Is that when you got involved in real estate, or is that just the realization that you're an entrepreneur at 40?
It was probably more the realization. I mean, I'm gonna spare you the boring details of my journey, but I was a financial advisor for most of my 20s out of college. 9/11 happened. I didn't lose anyone close to me in the towers or anything like that. I always feel bad saying that, but it was a defining moment in my life because it was a realization this isn't what I want to do. And I wanted to be in real estate. In fact, I tried to get into real estate first, and it just didn't work out, or I just didn't end up in the right situation. And so that week of 9/11, it was a Tuesday, so the markets were closed the rest of the week. There was a lot of soul searching done that week, and what I realized was that I said to myself that what do you want to do? I knew I wanted to be in real estate, but alongside of that, two of the wealthiest people, I should say that I know, meaning not Warren Buffett and Bill Gates. I don't know them. I mean, I'm in their phone. They were both in real estate. One's a developer, one on multifamily. I said, this is, I don't know how I'm going to get there, but I'm going to get there. And I ended up leaving. I told you I always had multiple jobs. So while I was a financial advisor, I was also a bartender. And the bar that I bartended at was a Villanova bar, and they were forced to close down. I didn't own it. Not my fault. There was an opportunity to buy that and reopen it as like a pub, bar, and restaurant. So I left the financial advising world, the stock market world, fulfilled what every, late 20, early 30-year-old male needs to do in his life, which is own a bar. It was, I will tell you, while I lost $100,000 in that experience, it was invaluable in that I learned a lot from that. I always say you're either winning or learning, right? And I learned more probably in that experience than I did in college. And so I knew after that failure and having to figure out what to do again now, that whatever I was doing was just temporary because I was going into real estate. And so I ended up, didn't know it at the time, right? Just took a job that my brother-in-law, got me interview with. It was to sell radio. I don't know if you remember the movie City Slickers, Billy Crystal. He says, I sell air. That's literally what I did. I sold air. He sold advertising on conservative talk radio in Philadelphia. And 2 of my clients over the course of a year and a half, I think I was there, were both in real estate. One was a mentoring program that sold mentorships to teach people how to buy, rehab, and either flip or rent single family homes. And then the other one was so I started doing that actually. I took their course, they were my client, started probably wholesaling homes because I was broke. I just lost a lot of money. I think I was wholesaling first. Then with a partner, we were buying and renting and buying and flipping. And that was fine. But you know how that goes. We just talked about flipping in Point Breeze, right? Flip. And look, you can make money, and there's some pitfalls there too. But I was charging forward with it, and I was still doing it. And one of my other clients was a developer, and it wasn't the developer himself; it was the sales guy. Said, "Hey, my buddy has a company needs a sales guy. They're raising money for 1031 exchanges. Don't know what that is, but there is money for 1031 exchanges for." He was buying multifamily and office at the time. This is 2005 and six ish, roughly. And so I interviewed with him, got the job, learned all about that, learned about 1031 exchanges, how they work. So now I kind of have one foot in residential, investment real estate and one foot in commercial. And I'm learning and experiencing both as I go. It was a phenomenal experience. But then the mortgage meltdown of 2008, as most people call it, really started in 2007 for us in commercial. The writing was on the wall, and here I was reinventing again because our industry went from 4 billion in 1031 exchanges down to like 250 million inside of a year. And so I had to reinvent again. I ended up at a tax lien seminar in Philadelphia at the Pyramid Club, where I was introduced to who became a partner of mine. And we launched a company. We started noodling on different ideas and found distressed debt and reperforming second mortgages, which everyone told us we were crazy. By the way, this is around the time I realized I was an entrepreneur because I kept having to reinvent and kept somehow surviving and reinventing. And so we started the company buying distressed debt. Everyone told us we were nuts. In the beginning, you introduced me, and I guess we send you a little bit about me, right? That you talked about niches, right? And how I realized I like niches. Well, this was my realization of niches, which is distressed debt and 1031 exchanges was a niche, but it wasn't a niche I found. It kind of found me. We found the distressed debt niche, both buying defaulted, not non-performing mortgages, getting them reperforming, and then selling them with super high yields. And we built a company. We still have that company, so we're 15 years later owning that company. I think we are probably the largest, if one of the largest, if not the largest buyer of charged off second mortgages, residential second mortgages in the country.
Wow.
Which is to say, we are a big fish in the world's smallest pond. This is like what nobody cares about this stuff, but they're out there everywhere, and we figured it out, and so we built that company, and it was going well. We were on this type of incline, and then wouldn't you know it, that got taken out from under us when the CFPB was created, and they just put these stipulations on banks selling debt that just made it so onerous it wasn't worth it. So we couldn't buy debt for 3 years. So I had to reinvent again. And along the way, because we were at I had been to so many different conferences. I mean, when I tell you I've been to Vegas 30 times, I can't stand Vegas at this point anymore. But for conferences, right? Different residential, commercial real estate conferences. And so somehow I was on somebody's list. Turns out I was on a gentleman named Scott Meyer's list, and I got an email about self-storage, and it hit me at the right time because I didn't know anything about self-storage. Honestly, literally, when I tell you nothing, I knew nothing about self-storage in 2016 when I got this email. Never rented it, probably drove by them, but never really noticed them. They never came. Not one self-storage operator came to a commercial. Well, they wouldn't go to residential, but never came to a commercial real estate conference. Not one, never saw one in my life. Not one operator. So I had no idea about it. So I get this email, and the catch tagline is "No toilets, tenants, and trash." That's enough to get your attention. It's not true. It's enough to get your attention. I always say it's not true because we have tenants. That's the lifeblood of the industry. And sometimes they leave trash, but there's no toilets. So as I investigated that further, what caught my interest was the same thing, similar, that caught my interest about distressed debt. In self-storage, and it's true to this day. It's changed a little, but at the time, about 80% of all facilities were owned by mom and pop owners, not public CubeSmart and self-storage and extra space. Today, that number is, depending on what you read, 70 to 75% are still owned by mom and pop. That to me, coming out of and still having run, because we were buying debt again, still having run and owning a very niche business in distressed second mortgages. What made it so unique was the fact that it was just this dislocated market. It was so fragmented. Nobody, one guy over here was selling this, one guy over here was selling it. There was no uniformity to it. And I loved that about storage. With so many mom and pops owning them, there's just still so much dislocation still to this day. So what I found was I like niches. I like going where people tell me not to go. And I'm not saying I'm running into burning buildings. I'm saying I'm curious. When someone's so sure that I should be running away from something or doing something else, I get really curious. What happened? Why? When the masses tell you to go this way, I'm curious as to why. What haven't they figured out, or what do they know? And sometimes they're right, but oftentimes they're wrong. And it's just that the opportunity to dig in and really try to figure it out, which a lot of people pass on. And that's what I realize I really like. And somewhere in there, I realize I'm an entrepreneur because that's what I do. That's what I've been doing, and I love it. And I wouldn't have it any other way. I'm completely unemployable, and I have been for 10 or 15 years at least.
I love where this conversation is going, because I've been involved in the multi space for well over a decade now. 2013, 2014 is when I started. You started quite early on in the self-storage space. I would argue today, at least in multi, the lane's freaking busy, right? It is a lot of people in that lane. I could argue that self-storage seems, and I'm not in self-storage, it seems busy like it's so similar to multi. You get a lot of guys jumping across and buying both, right? And do you think, given the peaks and troughs you've had in your career, with through all the different ups and downs, and that there's going to be a point where self-storage doesn't make any sense anymore? Because you don't think so?
Yeah. There are times where it's tough, but let me back up to the first thing you said there. The multifamily lane is very busy. There's so many people in it, and there's so much money that's backed by Wall Street in it, right? They've got that down to a science. I mean, it's almost like the stock market at this point. Wow, the way these things are value traded. Self-storage and multifamily probably has a similar similar band dispersion. Self-storage, 50,000 square foot facilities, maybe even down to 40,000 at this point and up. That's where you'll find the REITs and the institutions you've never heard. I'll say REITs, Public, CubeSmart, and Extra Space, because that's what you guys all know. There's a lot of brands out there you've never heard of. And there's a lot of institutions out there you've never heard of that operate multiple brands. So they're not as big as those guys, but they're fairly large. They operate in that 40,000 square foot space and up. Most facilities are under 40,000. It's not possible for the big guys to operate efficiently in those spaces. They're trying to partner with smaller guys like us. I'm not big enough yet, but they're trying to partner with smaller guys like us, or what we'll grow to, but they're not big enough. It's just not there. And on top of that, self-storage does really well when times are good. Economy's great. People buy stuff, they store it. When times are really bad, people downsize, they move. Self-storage does really well. It's that in-between stagnant period where self-storage struggles, where nobody's moving. We just found out in the last 2 years how important the transactional real estate market, not the value of the real estate market, the transactional real estate market is to self-storage, because nobody moved for the last 2 years.
Yep.
And
that's what I was gonna ask, because I follow a couple of the self-storage guys out there. I've had him on my show. Jay Scott's one of, that's right. AJ Osborne, and he's been on the show, and is Jay Scott. Yep. And I've had Paul Moore on, and they've talked a lot about self-storage around. But it has seemed like nothing's been immune from the last 2 years. So I'm going to pivot another way for you. Given your lovely head of grey hair, and that's a compliment, my friend, is how have you seen the last 2 years in comparison to '08 was hugely a massive issue, right? I was not around, but it definitely felt, at least in multi, some of the commercial spaces that like the last 2 or 3 years with the interest rates and the black swans that we kept on having and the stimulus checks and all that stuff, it was like we're falling off a cliff. There's blood in the street in multifamily right now. How have you seen any similarities between the two, looking back at '08 and what you saw happen back then compared to today? And coming around to self-storage, I don't think self-storage is as bad as, say, office or multi, but it hasn't been immune to the issues that have gone on the last couple of years.
Yeah. No, we're not immune to it. We're unique in that we really do require the real estate market to transact, right? That really hurt us. Also, and this is should not be undernotated. COVID, which is a pandemic that comes around how often? Like, I don't think we can count on it, right?
Right.
COVID was incredible for self-storage. Like it was probably the greatest 2 years in self-storage history, followed by the worst 2 years in self-storage history.
Yep.
So we had all these occupancies that would, pushing 100%, rates through the roof. And if you bought during that time, and we bought facilities during that time, your next 2 years, you struggled. You struggled big time because occupancies came down, rates came down, and no one was moving. So you couldn't even backfill it. So the last 2 years was a struggle. Do I see that happening again? Not unless we have another pandemic and what comes after it. The lessons learned were not so much of the overpaying, because we all overpaid for facilities. And this ties in.
Hey, we overpaid in multi, and I can tell you, I'll give you my 2 cents after this, but keep going.
Okay. You had to overpay if you were buying. If you were in the market buying, in hindsight, you overpaid and you just didn't know it. That wasn't so much the problem. You could have managed your way out of that. It was what happened after that, and no one had a crystal ball. That what COVID gaveth, COVID taketh away. And so one of the lessons learned was you have to operate the hell out of these things. These are businesses. But that's an interesting segue, and I know you want to talk about multifamily, but I wanted to kind of come back to something that we were talking about a second ago. It's an interesting segue into why is now the best time to buy self-storage and for who? Now is the single greatest time to buy self-storage for a number of reasons. Here, number one, when you buy self-storage, you're buying the trailing 12 numbers. So if you bought during COVID, if you bought in 21, you bought 2020 numbers for the most part, some 21, but a lot of 2020. So you bought the top NOI you possibly could, right? Only to not be able to duplicate it. If you buy today, you're buying some of the worst NOIs you've seen. Storage is on sale right now. Reason number two, most of these mom and pop facilities, I'm sure your audience is wide and ranging, right? But for anyone who's looking to get into the space, you're probably not looking to compete with Public on their next acquisition, right? Or Extra Space. There's an old saying, if you want to beat Tiger Woods at something, you can, just don't play him in golf. We try to do the same thing. We don't play against Public or Extra Space. That leaves most of the facilities for sale that are smaller, under 40,000 square feet. Who owns them? Mom and pops. How old are they? 65, 70, 75. They're all retiring. There's going to be a massive transition of self-storage ownership in the next 5 to 10 years. And this year and next year, you're buying off of discounted numbers.
No,
so to answer your question earlier, yes, the lane is crowded above 40 and 50,000 square feet. It's very crowded and very tough to buy. It's a coupon play. Who's got better, cheaper capital?
Yep.
That's who's buying those. Our capital stats are not like that. We have to actually compete and operate. And we're buying from mom and pop owners who aren't tech savvy, who aren't doing what we're able to do with these facilities. And there's a lot of value you can add there. So I'm not trying, I hope I don't come across as lecturing or anything like that. I'm just super passionate and excited about, especially with your question. You nailed it. Are we going to see the same thing again? And the answer is no. And then there's a third component to it. I'm 51. I'm Gen X. How old are you, Reed?
38.
38. You're millennial. 10% of my generation considers or uses self-storage. 30% of your generation does. You know how much the next generation plans on using it? Like 50.
Yeah.
Our population's growing and the users are growing with it. And back to multifamily, we're building smaller multifamily units today with less storage and less closet space and less everything. It's almost like they're forcing you to use storage if you're going to live in multifamily.
I love what you said there because, and I'm going to tie a bow around it as well. Like you're right, it's the trailing T12, and in most commercial space, you value the asset based on the trailing T12. You value the asset any business on a trailing T12, right? And it's when you have the best times and you're making a financial decision with these blinkers on because you can only see 12 months. That's where we all got screwed. And in the real estate space, in the multi space, when the stimulus checks and someone, again, COVID was people would household deformation, meaning that I don't need to live with mum and dad. I don't need to live with a roommate. I'm going to go out and get a 1-bedroom because I've got a bit of extra stimulus money in my pocket. Well, we're looking at rent rolls going, we can get a 2-bedroom for $1,900. Well, all of a sudden, when that money runs out, when people need to move back in, that $1,900 is more like $1,400. And that's where I think we all learned, including yourself, and I'm trying to tie the bow between the two industries and across the board and paint the picture for the listeners, is that investment decisions were made at a snapshot in time. You always remember that. And that's going to haunt that. I don't want to say haunt me, but I've got one deal that I wish would burn to the ground that I bought in 22. And everyone's got one, right? Let's not not try to be proud. And that's, I think, the biggest lesson coming away from that time. I don't know if we'll ever have that combination of black swans all at once. I don't know in my lifetime, but you got to take those lessons with what did you learn from that? And I completely agree with you because right now multifamily is on discount, right? Because we've got so much delinquency, we've got so much rents have dropped off, and rents are only going to pick back up over a 10-year hold. Your rents are going to be more than what they're going to be, what they've declined. So I think today's a really, really good opportunity to be buying across the spectrum, from self-storage to multifamily to mobile home parks. Whatever you can get your hands on the commercial real estate industry, it's really quite lucrative right now.
It's all on sale right now. And I think one of the lessons we've learned, we're even learning this from, we sell facilities too. And so when we talk to brokers, for instance, we were going to list a facility for sale soon. We're not going to, because what we're learning is even the big, because we take facilities and we take them from mom and pop and we institutionalize the management of them so that we can sell. It's like turnkey to the big boys. They're not modeling any rent growth right now. So what you probably did and what we did, because that's what you knew to do, was when you bought something, the T12, you modeled in whatever rent growth, and that's how you were going to create the value. Well, sounds like we have similar stories. Just you bought them, and not only didn't have rent growth, you had rent decline. So the big guys right now in self-storage, they're not even modeling growth. They're just buying. They're almost land banking self-storage when they're buying. They're saying, you know what, we're going to buy you, but we're not going to model anything, and we're going to wait a year or two, and then we'll start growing rents again. Yep. So it's really interesting.
It's super interesting that you bring up the transactional element of it, right? When you have people moving or not moving, and for us in the multi-space, the fact that there isn't interest rates are high means our rents are our occupancy is now starting to go back up again and start to be, depending on where you are in the country, right? Phoenix versus Austin versus Charlotte, but when interest rates are higher, people rent for longer. But when interest rates are higher for you, people don't move, and that's a problem. Right. And that's where because I'm literally thinking about it right now. I've got a 2.99% interest rate on a property here in Los Angeles. And I'm like, God, if I move right now, I'll be double, right? Wherever I buy. And so I'm one of those people, right? I'm not moving because I've got such a great interest rate. But I didn't kind of put two and two together from the self-storage space that had such a big impact to your bottom line.
Yeah, I don't want to overplay it. It's important. It definitely is a factor for us. I should have really said the combination of the last 2 years of the interest rates. Nobody was moving because the interest rates in the economy, right? Yep. Could afford to move. interest rates will I think you guys will see it too, right? They normalize and they become normal, and then we get back to just the normal day to day. Like there's always going to be transactions once interest rates normalize, and they have, I think, for the most part. And I don't really care if they go up a quarter point or down a quarter point. I don't think it's make a huge difference. If it goes down to 4%, you're not happy, but obviously we are. But it was the economy that really crushed it. But interest rates part of that, right? They went from 21 to 24. They went up like 400 basis points at least. It was that, and nobody was making money in the cost of gas and eggs and everything else. It was that stagnation that crushed us, and that stagnation that stopped people from moving. I'm super excited for both of us right now because I'm telling my team we're in the right place in history right now. And by the way, if I could add a fourth element, I'm not trying to make self-storage better than multifamily. I invest in multifamily. I love multifamily. I just don't operate it because I don't do it as well as you. But one unique thing for anyone looking to get into self-storage, who's you're looking at, maybe a 40,000 square foot property or less. That's where most of them reside, and that's you're probably even if I dump it down to 20,000 square feet, you're in that $1 million acquisition price or less. So it's attainable, right? But one of the unique, fun differences is we're a business. So from a financing standpoint, Reed, if you want to go buy a 10-unit apartment building or a 20-unit apartment building, you're going to go get a traditional bank loan for 75 LTV. Is that fair?
Mm-hmm.
We're a business. We can use the SBA. So first-time buyers can use the SBA and get 90% financing because it's a business. To buy real estate, that's what's neat. Yep. To me, that's really neat. I mean, we're not the only ones, hotels, bowling alleys, whatever. You have to operate a business. That's what the SBA is for. But storage is a business. I think that's a unique differentiator for anyone looking to, if you're not in real estate, first of all, you're listening to a great podcast. I don't know what you're waiting for. Hopefully you're getting the motivation. If you listen to Reed all the time, hopefully he's motivated you by now to get into real estate. And I don't care if it's multifamily storage or mobile home parks. They're all amazing. Find what your passion is and get into it. Just start taking action. Information is out there galore. And thanks to guys like Reed, because I didn't have podcasts to listen to growing up, if you will, in my 20s and 30s when I wanted to be passionate. I had a couple of guys in Philadelphia telling me this is the way, and that was it. There was no other place. I guess we could buy books, right? Right. You could go to seminars and conferences, but I couldn't drive around in my car while I was looking for houses, listening to Reed talk about, what you should and shouldn't be doing or different ideas and what. So it's an amazing, we live in the information age, and thanks to guys like you, you're out there disseminating that information, and that's awesome. But you got to take action. Yep. You have to take action.
If I had another 2 hours with you, I'd get into the whole on my what's it called? Standing on my table about how much, because you mentioned ambiguity at the beginning, and I think that's so important. And when I got in the multifamily space, there was a lot of ambiguity. The coolest thing since sliced bread was getting an investor to sign via DocuSign. Today, I know within a click of a button what 1 bedrooms, what 2 bedrooms, what 3 bedrooms. So the ambiguity has completely evaporated from the multifamily space. I can see it happening in the larger institutional self-storage space because, that's what it is, and it's all access to data. And that's really an interesting time. And it's a tidbit, and I'm not going to get on my bandwagon to say whether that's, is it dead or is not dead? There's always opportunity out there, but it has been a big transition for us in the multi-space that the access to data was so ambiguous back in 2012, 2011, 2013, and now today it's not. And so the barriers to entry to starting a multifamily investment firm is quite low because your access to data. I think that has caused some compression of cap rates as well, by part of, with obviously interest rates as well. But that means you've got to operate it razor thin. And so understanding that when you're been in the industry for as long as we have, seeing that compression and the razor thin operating margins, you have to make the right investment decisions. And when you do something in 2021 or 2022, that's when you start getting into a little bit of hot water because those things, all the floor went out from underneath you. But as we come to summarize the rest of the show, come towards the end of the show, I should say, what's the plan for 2025 and beyond? Are you aggressively buying right now? Are you looking to expand? What does the systems look like within your ecosystem?
So Belrose Group has not deviated from our plan. We are looking for value add mom and pop facilities that we can go in and create value for ourselves and our investors, right? So every facility we buy, we have money in it, but we also have passive investors in. We also teach people how to buy and consult and wholesale. So a lot of these smaller deals that don't work for us because of our capital stack, we place people in all the time. The $500,000, $700,000 acquisition, maybe it's 10,000, 20,000 square feet. We do I love that. I also teach at Scott Meyer's Academy. So I'm passionate about self-storage. I love giving back and all that. What I'm super passionate about is my baby is, I told you I love niches, and even within self-storage, there's niches within the niches.
Mm-hmm.
And so what we have realized, we bought it. I'll keep it. I know we're at the end here. I'll keep it brief. One of the facilities we bought in Wilmington, North Carolina along the way was a little different than the others in that the unit sizes were bigger and our customers were different. They were contractors. So, a self-storage, your 2-bedroom apartment, if you will, of self-storage is the 10 by 10, 100 square feet, 8-foot ceiling, right? That's the roll-up door. That's where you're storing all your most treasured possessions. In this facility in Wilmington, North Carolina, the smallest unit size was 450 square feet, right? 14-foot ceilings, big roll-up doors, drive your truck right into it, right? So that was different than all the others. And again, I'm telling the story quickly here. What we realized with the dawn of e-commerce is that all these last mile warehouse needs were pushing out all of those existing users of those 20 and 30 and 40,000 square foot warehouses, right? That are now housing the product that you're about to go on Amazon and buy so that it can get to you same day or next day. And I don't know if you know this, Amazon and Walmart, the two largest online retailers now, know, and we know too, if they can't deliver a product to you same day or next day, they lose 25% of their sales. That's today. Next year will even be more. So the onus, the impetus, the importance of having the products available to deliver to you same day has never been more important. The downward pressure that's putting on the users of those warehouses by driving up demand in the rents is who are they forcing out? Contractors, small business owners. So that's what we're building. We're going out and building self-storage facilities, but for businesses. So we call it pro storage. Same concept, looks the same if you drove by it. Unless you really studied it, you wouldn't be able to tell the difference between that and a regular self-storage facility. But
has it got a mezzanine level in it?
No, it's just a 14-foot, so you can drive your truck in, your box van, whatever, with ladders on top. You're storing your inventory, your equipment, whatever. Yep. Or it's just overflow inventory. Or think about the catering company who needs a retail storefront to sell the wedding, the froofiness of the wedding. But where is all the glasses and the plates and chairs and tables? Where are they? They don't need to be in the $25 square foot space. They can be in the $12 square foot space, right?
Yep.
And you could drive an RV or boat into these things, right? Mm-hmm. So it's a multi-use. But that's my passion today. Is we're out there building pro storage facilities. So it's just
you should check out a good friend of mine, Aussie guy Tim Manson. Shout out to Tim. He started X Space in the US, and it's actually built up. It's condominiums for storage, but it's got a mezzanine level and it's double height, and that's where you have your office, and then down below you have, and then you can also punch the wall between them and have two spaces next to each other, and it has a common area like a multi, so you can have you meet for whatever, but it's all air conditioned. That's high end stuff, but there's and another.
So he's that small bay flex, they're calling that, right? Yep. So it's actually that's more of a lease scenario where you're going to lease it for a year, 2 years, 3 years, right? And we're looking at that too. We might even dabble as well, because the under 5,000 square feet in warehouse space is the most neglected space in the country, and it's in the most demand right now. So what your buddy Tim's doing is brilliant, makes total sense. We're just coming at, there's a line between the two, and that's and that comes down to like a use and occupancy, right? So we don't have anybody working there. He does.
Yep.
And so we're maintaining storage. He just crossed the line the other. Both are going to do very well because that demand is there across the country. Really, it's international because
Yep. I love
e-commerce
it.
isn't going.
Love it,
Yeah.
mate. Well, look, we're coming to the end of the show. I'm going to do top 5 investing tips. You ready to get into it?
Top 5 investing tips?
I'm
Okay.
going to ask you 5 questions at the lightning round. So you haven't been prepared for these questions, but that's the beauty of it. So question
Okay.
number 1 is, how do you
Nervous.
prepare, or what's your daily habit you keep on track towards your goals each and every day?
Yep. So I am behind you is the book Who Not How, written by Dan Sullivan, who also has a coaching program called Strategic Coach. I'm not sure if you're familiar with that. I go to that once a quarter. In fact, I just got back from Toronto the other day. We're at their headquarters. And I actually, the night before, I plan my entire day and week, and you set weekly, quarterly, monthly, yearly goals, and try to. If Dan's listening, I'm doing my best. But actually, I've never met Dan, but my coach Gary Monner said, if he's listening, I'm doing my best. That's how I try to stay on top of and keep things in focus. And what's one of their sayings? If you pay attention to your intentions, you gain momentum. So that's what I'm consciously trying to think about my thinking.
Gotcha. Awesome. Question number 2 is, who is the most influential person in your career to date?
Scott Myers.
Question number 3, what is the most influential tool in your business? When I say tool, it could be a physical tool like a notebook or a phone, or it could be a piece of software that you just can't run the business without. What is it?
It's a piece of software. I don't even use it, but I know how valuable it is. It's called Veritech. And it manages the rates at our units, not only down to the unit size, but to the day, to the point where it can change. So it's basically what REITs have their own proprietary. This is for anyone to use, but it's the same kind of software. It's like hotel software. Mm-hmm. So it's measuring demand, or actually like Price Labs, if you're familiar with Airbnbs. It's measuring the demand of units based on the absorption rate of the market and what's available at any given time. You can manage self-storage without it. You're just not as smart with your rates if you're not using it.
Gosh, awesome. Question number 4 is, in one sentence, what's been the biggest failure in your career, and what did you learn from that failure?
Definitely buying and owning and operating the bar and restaurant outside of right near Villanova. What I learned is what I tell everybody. I knew the front of the house, which was the bar part, because I'd done that for 10 years. I managed that in my sleep. I didn't know how to run a kitchen, wasn't experienced. And the kitchen is what did me in. That's where all the cost was. So it's not famous, but my saying is you have to keep your head in the kitchen.
Yep.
And that's true in self-storage. I made the mistake with a couple of facilities. We allowed a third-party manager, not a big one, but a third-party manager to manage our facilities. And we didn't keep our head in the kitchen, and we're paying the price for that now. So you have to keep your head in the kitchen of your operations. It's fun to grow. You could probably tell I'm the sales guy, the talking guy, the investor relations, right? I'm the growth oriented mindset guy, but you have to keep your head in the kitchen, because it'll kill you if you don't. It'll take you down.
Yep. Love it. Last question is, where can people reach you to continue the conversation that'll be in your sphere? Where do they go?
Our website and my email is probably the best. So belrosestorategroup.com. And my email, if anyone's interested in either passive investing in self-storage or active, if you're thinking about, looking at buying a facility or getting into the game, just email me, joe@belroseam.com. So it's BELROSE, A as an asset, M as in management.com.
Awesome stuff, mate. Well, look, I want to thank you so much for coming on today's show. A couple of things I took away from today's show. I think your ability to keep pivoting or zigging when you should zag, and a lot of things over your career have handed you opportunities to grow. And I think understanding that and really diving into that, what you saw in the last couple of years and how that compares to 2008, I took a lot away from in your insights, given that you've been a lot at this a lot longer than I have. But then understanding what your lane is. When the lane starts becoming busy, keeping your head in the kitchen, so to speak, but keeping your focused on what you do well. And that's I think you said 40,000 square feet self-storage, because the big boys aren't going to play in it, and owning that space well. it means that there's you're going to have a successful business for decades to come. So that's just a couple of things that I took away. So thank you so much for jumping on today's show. Enjoy the rest of your week, and we'll catch up very, very soon.
Thank you so much for having me. I appreciate it.
My pleasure. Well, there you have it. Another cracking episode jam-packed with some incredible advice from Joe. If you want to check him out, head over to www.belrosestorategroup.com. Anything related to storage in that sort of sub 40,000 square foot space. And I'm really excited to see that last mile self-storage that he's starting to build with that 13, 14 foot bay areas. Super, super exciting. So if you do want to check him out, over at belrosestorategroup.com. I want to thank you all again for taking some time out of your day to continue to grow your financial IQ. It's what we're all about here on this show. The easiest way to give back to this show is to share it with a friend or give it a 5-star review on iTunes. You can catch all the content from this show on my website at readgoossens.com. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.